Real estate investors are entitled to some of the absolute best tax breaks in the entire tax code. However, most people are just completely unaware of them because they're not taught in school. And it's not like the IRS calls everybody up to make sure that they're well educated on the tax code. So today, I thought, why not we shed some light on the incredible hidden benefits of real estate investing and also take some time to answer some of my tax questions that are coming in from you subscribers. Without further ado, let's dive in. Why does real estate investing have great tax benefits? The first thing that I want you to understand about the tax breaks of real estate is why they exist in the first place. The US government set up the tax code to incentivize certain activities. What I mean by this is that the government gives specific tax breaks in order to motivate people to do certain things that it wants people to do. In the case of real estate investing, the government has provided tons of tax breaks. And one of the main reasons why this is the case is because the government wants to make sure that there are enough people investing into real estate so that it doesn't have to provide all of the housing themselves. Just think about what a tremendous burden that would be on the entire government if they were solely responsible for creating all of the new housing in the country. It is far easier for it just to provide tax breaks that motivate private citizens to create housing. Additionally, the government tends to give the lion's share of tax breaks to business owners and investors as opposed to employees. And this is because the government understands that both running a business and making investments require risk. Businesses and investors are crucial to keep our economy running. So it provides tax benefits to motivate investors and business owners to keep investing and running businesses, even though there is risk associated with these activities. Now let's move on to the actual tax benefits of real estate investing. Depreciation. One of the best tax breaks of real estate investing is depreciation, so I'm going to start with this one first. If you invest in rental real estate, the government allows you to deduct the entire cost of your rental property structure. I say rental property structure instead of rental property because the land portion of the property is not tax deductible. To understand how significant this is, let's say you bought a property with a building value of $1 million and a land value of $100,000. In this case, you would be able to write off the full $1 million cost of the building. The reason why the government allows you to do this is because it views real estate investing as a business and it views the property structure as a business expense. Keep in mind that there are rules for writing off depreciation. For example, you have to write off your property depreciation over the course of 27.5 years for residential properties or 39 years for commercial structures. The reason why this is such an important tax benefit is because even though the government allows you to deduct the depreciation costs, they don't necessarily mean that your property will be fully worth $0 at the end of the depreciation period. In fact, because properties tend to appreciate with value over time, your property will most likely be worth significantly more than what your original purchase price was at the end of the depreciation period, even if you paid significant cost for repairs. To understand how this works, let's go back to that $1 million property example from earlier. Let's say that over the course of 27.5 years of you owning the property, you had to pay $300,000 for repairs due to depreciation. The government will still let you deduct that full $1 million. Also, by the time of 27.5 years expires, your property could be worth $2, $3, or even $4 million or more. The reason why this is so significant from a financial perspective is because the government is giving you a massive depreciation deduction for an asset that in most cases will actually appreciate. By doing this, the government allows you to dramatically reduce your tax burden while you generate cash flow and your property appreciates at the same time. Many of the wealthiest people in the country are well aware of this amazing tax benefit. And that is why real estate is one of the preferred vehicles for creating generational wealth amongst the richest families in our country. How about number 2? Accelerating depreciation. Although the standard depreciation deduction for real estate itself is very incredible, there's actually a way to take a much more advanced version of depreciation. Real estate investors can perform what is called a cost segregation study to accelerate a large portion of their depreciation expenses. A cost segregation study is done by qualified professionals, and it segregates the cost of a rental property into 2 categories, structural and non-structural. Non-structural costs such as carpeting, lighting, appliances can be depreciated on much shorter timelines. So if you have a cost segregation study performed for your rental property, you can actually claim a larger percentage of that depreciation deduction in the first 5 to 7 years of owning your rental property as opposed to 27.5 years. Oftentimes, real estate investors can claim 40 to 50% of the depreciation in this time frame. This is much better than having to wait years or decades or even longer to claim much of your depreciation. If you want to know how much money depreciation could accelerate for your rental property and how much money this would be able to save you in taxes, check out the cost segregation calculator in the description below this video. You can calculate this directly through our website. Number 3, other deductions real estate investors receive. In addition to being able to deduct depreciation, real estate investors can qualify for a wide variety of other deductions, and each additional deduction that real estate investors qualify for can help to reduce their tax burden even more. Here's a list of some of the other deductions that typically get skipped over when you think about real estate: mortgage interest, property taxes, the repairs, maintenance, insurance, management, marketing fees, utilities, travel, vehicle expenses, legal and professional fees, home office expenses, and guys, honestly, much more. There are many different types of costs that you could potentially write off as a rental real estate investor. You should work with your tax professional just to make sure that you write off every last expense you're eligible for in order to optimize your tax savings. I recommend doing this before tax season. Number 4, offsetting W-2 or 1099 income. Another amazing benefit of real estate investing is that in some circumstances, real estate investors are allowed to use real estate losses to offset their 1099 or W-2 income. Let's say, for example, you qualify as a real estate professional. You can use your real estate losses to offset your W-2 or 1099 income. If you're married, your spouse can qualify for the both of you. There are several requirements to reach this status. For example, you must spend 750 hours during the tax year in real estate related businesses. And you must also spend more than half of your working time in real estate related activities. Most people will not qualify for this option. However, if you or your spouse works in the real estate industry, there's a high chance that you do qualify. Another way to qualify to use real estate losses to offset W-2 or 1099 income is with short-term rentals. If you have a short-term rental such as an Airbnb or VRBO, you can use real estate losses to offset primarily W-2 and 1099 income if the average guest days are 7 days or less and if you materially participate in the business. For most people, taking this approach is going to be a lot easier than trying to achieve real estate professional status. Many people who use the short-term rental strategy in combination with accelerating depreciation are able to reduce their taxes by up to 50, sometimes up to 70%. This is because depreciation and other tax deductions completely offset their rental income and also offset a huge portion of their primary income, which is their W-2 job or their business. If you like to learn more about this strategy, then you can watch this video right here. Let's talk about number 5, step up in basis. If you don't know what step up in basis is, it is when the cost basis of an asset, such as a rental property, is stepped up to its current value in the market when it is passed from one person to another after death. The benefit of having an asset stepped up in basis is that it means that the person who receives it does not owe capital gains taxes on all the price appreciation that took place while the person who died held on to the asset. So to understand how this works, imagine that your Aunt Janine had a gorgeous rental property in Miami right by the water. She bought this property in 1988 for $300,000 and today it's worth $6 million. She leaves the property to you in her will. Without step up in basis, you would immediately be liable for the $5.7 million worth of appreciation that occurred, and you would pay capital gains taxes on it when you sell. But because of step up in basis, you get stepped up to $6 million, where it's worth today when you inherit it. That means that you would not be responsible for paying capital gains taxes on the $6 million worth of price appreciation that the property experienced throughout the period your aunt owned it. See the difference? Step up in basis is another one of those amazing tax secrets that real estate investors have been benefiting from for years. It's also another one of the reasons why the rich use rental property as a means of passing wealth to their children. Now, I love those reasons I gave you, but there are more. What I want to do, as promised, is answer a question from one of my subscribers. But before I do, I just want to remind you guys that the Tax-Free Wealth Challenge is taking place March 10th through March 14th, 2025. It is one of the largest digital tax conferences in the world. Over the course of 5 days, I will teach you the most powerful and advanced tax strategies that I know. the ones that really make the difference on the tax return. These strategies can literally reduce your tax bill by 50 to 100%. The link is in the description below if you're interested. Now, back to the subscriber question that I got asked. The question was asked by Joe Brooks 9175 on my How to File Business Taxes for the Very First Time video. The question was, Karlton, do I still need to save the gas receipts or any other receipts if I use my business bank account to pay for my expenses? The transaction shows in the bank statements, isn't that proof for a tax write-off? Unfortunately, the answer is no. The IRS has a rule that if you have an expense that's under $75, it's considered a de minimis expense. You don't need to save the receipt. But any expense above $75, you must save the receipt. And that is for tracking purposes. Just spending your money at the gas station doesn't mean that it was spent on your business vehicle. It could have been spent on your personal vehicle. So the IRS wants to see the receipts. They also want to make sure that they know what you're spending your money on. If you go to Home Depot and you spend $1,000 at Home Depot, how is the IRS going to know that the $1,000 were spent on supplies and materials for your business versus supplies and materials that could be used for your primary residence? They do not have a way of tracking this without formally looking at the receipt, which typically comes up in an IRS audit. If you're trying to outsmart the IRS, be sure to subscribe to this channel because I will be teaching you more tips and tricks to make you smarter as you build your wealth. My name is Karlton Dennis. Thank you so much for liking this video. I want you to do something for me. Smash that subscribe button. I look forward to seeing you on the next one. Cheers.